Good afternoon, everyone. This is T3 Live Editor-in-Chief John Darsie here to bring you the daily recap. First video I've done here in 2014. I want to wish everyone a happy new year. It's been an interesting year so far for sure. Yesterday, as we talked about in today's morning note, we closed out the 5th trading day of the year. And a lot of people point to the first 5 days of any year as a barometer of how that year as a whole is going to play out. And if that holds true this year, we're not in for the type of years that we've had over the last few. We actually finished negative for the first 5 days of the year, as I'm sure you've read. And then today you saw some interesting action that was actually a little bit different than what we've seen so far to start this year. Yes, it was choppy, sort of indecisive type action that we've seen for most of the year. But as in the start of the year, what we saw was the indices were somewhat lethargic. We saw, like we said, the indices finished lower over the first 5 days. But if you were a trader in the market trading momentum stocks, the first 5 days of the year were tremendous trading days. You had a lot of huge moves in stocks. A lot of small cap speculative type names were ones that were leading the tape, along with things like the banks and the biotechs yesterday. But you saw a lot of good trading action in individual names, whereas the indices were somewhat weak and choppy. And today you saw somewhat of the opposite, is that the S&P was able to actually eke out a gain with a late day bounce. But a lot of stocks, individual stocks that we watched, the momentum traders watch, were extremely weak today. So it gave you a lot different taste in your mouth after today's action than you got. Despite the fact that indices were lower the first 5 days, the action felt a lot better than it did today. We'll go ahead and take a look at the chart of the SPY and show you some examples of what I'm talking about. As you can see, the S&P was able to bounce off its lows today, opened higher, gave people some hope that it might be able to build on the stronger last 2 days that we saw in the market, but traded sharply lower, below yesterday's low even, and then bounced in the afternoon to get back just narrowly above the flat line. But the NASDAQ and the Dow finished narrowly lower. So, you look at the market and say it was a quiet day, but in reality, there was some damage and some warning signs, or at least some signs that things might slow down from where they started at the beginning of the year, just in terms of individual momentum names. And one example of that right now is the social media names. Social media obviously was a huge trend to end 2013 with the Twitter IPO and then Facebook getting added to the S&P 500, the S&P 100. Those were big catalysts that helped those stocks move higher. And then Twitter is just extremely strong after that initial consolidation period after its IPO. But take a look at the chart of Twitter. Twitter, huge swings here. I mean, you talk about the small float in the IPO. Yes, it's helped to increase demand for the stock because there's not a lot of supply there. And that's what really drove this huge move, this parabolic type move that we saw in the weeks after in the base that formed after the IPO. But then it formed a little bit of a wedge pattern. I say wedge pattern very loosely because it was a very loose wedge type pattern. But what you saw was volatility sort of shrinking every day, but it was still a lot of gaps and a lot of very volatile action in Twitter. And then we got a resolution to the downside of that very loose wedge pattern. And today, Twitter was able to close a little bit off of its lows. I think a lot of people are very excited about the potential to buy this stock lower, and I would tend to agree with them. I think it's gotten a downgrade just about every single day this week, and I think it actually has gotten a downgrade every single day this week. So every morning it has some weakness that it has to fight off. And all in all, given the fact that it's gotten all those downgrades and had to maybe absorb some of the profit taking at the beginning of this year, not the end of the world. It's sort of around the 50% retracement from this big move higher that it saw. So the fact that it was able to bounce off its lows of the day today gives you a little bit more optimism that it could bounce even further just from the afternoon bounce that we saw today. I know Mark Sperling's involved with it on the VTF, and some other guys have been playing it. It's definitely one that's so volatile that you definitely need to have short-term trading momentum type skills to be involved with it. But I do think this is going to continue a lot higher in 2014 overall, and over the next few months I think you'll see Twitter higher because of that lack of supply increasing. Some will say artificially increasing demand. I don't think artificial is the right word for it, but I think it just affects the price action of the stock significantly when you have that small float. And then Facebook, also a weak day today, not quite as volatile as Twitter. Twitter sort of overshadowed the action we've seen in Facebook over the last month or so. Facebook was extremely strong. A little bit of a pullback here into the 21-day moving average back in late December, but then rallied strongly. Looked like it was going to make new highs, and it did make new highs today actually. But a red dog type reversal engulfing day. It's a very bearish looking candlestick in the context of this chart as it made new highs today and then closed back below, engulfing the previous 2 days price action. Was able to, like Twitter, bounce off its lows of the day and like the market bounce off its lows of the day, but not a real convincing bounce. And that candlestick tells you that this might need a little bit more of a pullback, perhaps under the 21-day, back into this $54 area that the last pullback came through. That'd be your first area to look at if it does continue lower. So one to keep an eye on, just something to take note of as a weakness in the social media stocks. And what we saw also at the end of last year was we saw divergence between Facebook and Twitter. They generally traded together very strong. And LinkedIn. LinkedIn was the darling of the market for a long time, the darling of social media. A lot of people talked about how LinkedIn was the grown-up of social media and Facebook was the pretender. That narrative got flipped on its head, and LinkedIn was weak towards the end of last year. We'll take a look at the chart. And now LinkedIn today was extremely strong. But we zoom out a little bit, I'll show you some of the choppy type action that we've seen over the last few months in LinkedIn. While you've seen Twitter and Facebook rallying really impressively, you've seen LinkedIn be mired in a downtrend. We go to the weekly chart to get an even better look at it. Very methodical type downtrend in LinkedIn, but then you see on the weekly chart a red dog reversal on the weekly chart. So red dog reversals it's a pattern that can be applied on all different time frames. It can be applied on an intraday time frame. It can be applied on daily charts. It can be applied on weekly charts. It can be applied on monthly charts. It can be applied on any time frame. And as you can see on that chart of LinkedIn, if we go back to the chart, you can see a really compelling red dog reversal on the weekly time frame. It's had 1, 2, 3, 4 weeks down, and then this week traded down below last week's low and then has reversed impressively back above it. You take a look back at the daily chart, you can see today's really impressive price action. This was the big candlestick, the bullish engulfing candlestick that told you LinkedIn wanted to go higher. Yesterday, a little bit of a digestion day after it opened higher, and then today stretched its legs nicely. So maybe you could see some money rotate back into LinkedIn after the other two got a little bit extended, a little bit ahead of themselves maybe. Some interest might come back for LinkedIn, and the technicals would definitely point to a little bit of a bounce back there. And then Yelp is another one that would fall into that category of Facebook and Twitter, where it's been extremely strong recently. We highlighted this pattern, this descending channel pattern on Yelp and off the charts. Not dissimilar to what we're seeing in LinkedIn right now, so maybe you could see that type of move in LinkedIn, but we highlighted this one off the charts for a move back to highs around 76. We got that move, took it off the watch list yesterday, and then today we got a little bit of a reversal. Not a terrible reversal, still finished around the flat line, but closed well off its highs of the day, so not the ideal type of price action that you'd want to see. And then the banks today. The banks are absolutely leading this market right now, and they were a focus in Scott Redler's 2014 outlook as well. Bank of America seems to be the cream of the crop right now, not even giving you a potential entry on a retest of the 8 or 21-day moving average. We talked in his 2014 outlook about looking for, like I said, that retest of this prior breakout level around 16 would be the ideal entry there, or just some sort of sideways consolidation that at least allowed this 8-day moving average to play catch up and catch up with the current price of the stock. But today it doesn't look like it's going to provide you that. Today it did close a little bit off its highs, but nice move. 2 new 52-week highs for Bank of America. Still looking promising, but I still think it's a little bit too extended to buy right now with some of the choppy action in the overall market. But like I said, sideways action, ideally a retest of the $16 area, be a very compelling place to get involved with Bank of America. Citigroup, very similar story, but has been even stronger over the past few days than Bank of America. Ideal entry would be on a retest here of the just below 54, but not really giving you a way in. So what you might want to look for is just a little bit of rest, a pullback, just again to allow that 8-day moving average, which is a very short-term momentum type moving average, to play catch up before getting involved. But just important to note the early, if you say the first 5 days of the year are very important for as a barometer for the market for the year ahead, then you have to use that determination for individual stocks as well. And so you could say this year, on a relative strength basis, that the banks look like they could have a really strong year, and I agree with that notion. You look in the context of the broader chart where they came from before the financial crisis. I know the environment for the banks and regulation has changed dramatically, but I do think these things have a lot longer to go. If you zoom out a little bit, don't get caught up in where they've come from over the last 3 years. Look in the context of the broader chart where they were before the financial crisis. That gives you a little bit of perspective on where these things, they're not going to get back to highs by any means. You look at where Citigroup came from, but there still is a lot of room left on those charts. Biotechs were strong today, and there was one main reason for that. First, I'll take a look at the IBB just to show you the strength that we've seen in biotechs. Late last year, I came on a video, and I talked about how the banks and biotechs, I'll put the link in the daily recap article to show you the video that I did. The banks and biotechs look like sectors to me that are going to perform well in 2014 against their peers. I think a lot of tech is a little bit extended. I think some select tech stocks. It'll be a very selective type environment, but biotechs and banks, I think, are two sectors that technically are looking very promising and look like I said, they could get some continuation to the upside. And you saw a nice upper level flag in the IBB, which is the biotech ETF. Really nice extension yesterday and then open higher today, largely as a residual effect of Intercept Pharmaceuticals. Not often that you see these types of moves in the market. It either set a record or came close to setting a record for the largest single day percentage gain for a stock ever or in some index, but almost a 300% gainer. Was even more at one point. It was over $300 a share at one point during the day, but finished just shy of a 300% gain after they announced really good progress on, I think, a drug that has to do with liver disease. So these biotech stocks, they're slippery in both directions. They can give you huge gains. They can give you huge losses. It's all up to how their drugs perform, and this one has boosted the sector. And I think when you see a move like this, what it does is it brings the chimps into play. It has people that are going to always be looking for the easy money, looking for that next big payday, that lottery ticket. And you're going to have people scouring the pharmaceutical biotech group looking for the next ICPT. And you did get some sympathy plays today. I can't remember the symbol, maybe GALT, that some people in the VTF were looking at. You're going to get some sympathy plays off of this, but I would caution you against thinking that you're going to get 300% moves in stocks all the time. That's not realistic. But what you could do is look to some established names in the biotech group to see if just the fact that this did happen is going to get positive press. There's going to be the herd chasing opportunities like this. You could get some residual impact across different stocks in the biotech group. So something to keep an eye on there. The casinos, MGM was another name that Scott mentioned in his 2014 report. I'm not going to give everything away. I'm just going to give you a couple samples from that report. But MGM is a name that one reason I'm mentioning it is because it's run a little bit further than we would have liked before including it in the report. Obviously very strong since November, really steep uptrend, extended higher again today despite the choppy market. You really want to wait for a pullback on this one, especially how extended it is from that run in mid-November. But this is just an example of why it's valuable to be on the VTF, why it's valuable to have off the charts, is that you can come out with an outlook and a roadmap for a year ahead, but the real opportunities, especially this year after the big run the market had in 2013, is going to be active opportunities, identifying more intermediate term trends and looking to be a stock picker and a market timer at key areas in individual stocks and in the market. In high beta tech, I'll just run through really quickly. Very weak today, pretty weak. I wouldn't say very weak. It wasn't anything too alarming, but I think what you're seeing is a sector that was really hot, obviously, in 2013, needing a little bit of rest, and I think that's going to be a little bit of a problem for the broader market. The NASDAQ showed a little bit of relative strength today with a loss. I'll just run through some symbols real quick. Take a look at Apple. This is one that, from a value perspective, I really like Apple, but technically the China Mobile deal wasn't able to really give it that extra push that I think a lot of people wanted. It was a huge accomplishment for Apple, but what it appears to be is that it was priced into the stock at the current level. So I think what Apple needs now is another refresh of their iPhone line, new product line, something new and exciting. Apple's able to have this big bounce this year without coming out with anything new and exciting in terms of new product line. So I think that might be the catalyst that it needs if it's going to have another big move in 2014, and I think those product lines might be coming. But today, technically, big bearish engulfing bar that tells you it wants to go lower. Maybe a retest of that 520 area would give you a more compelling area to be involved long-term in Apple. Amazon, just run through some of them. Not terribly weak, but a little bit of a reversal after being strong early in the day. Google, strong stock I love in a macro sense, a little bit extended, basically just retesting this prior breakout level. See if it holds the 8-day. If it does, nothing to cry about. Let's see here. Tesla, not exactly in the same category as those, but one that we highlighted off the charts, this descending channel here that broke higher out of it yesterday, but then was weak today to get back into that channel. So look at the lower trend line of that channel, and that pivot low right here stands around, let me get back on this tool, pivot low stands around 145.24, so that's an area to watch if it continues lower in Tesla. Netflix, continuing lower. This is one that much weaker than something like a Google or an Amazon. Looks like it could be headed lower after a really strong comeback in 2013. today broke below pivot lows, and not necessarily one that I would look to short. I don't know that I would really look to short anything in this market until we get a little bit more confirmation of weakness. But if I were to start formulating a short list, Netflix looks like one that's a little bit more ripe for some downside, as well as a stock like Lululemon. Spoiler alert, this one might be on off the charts tonight to give away a little secret sauce. Talk about the H pattern that Mike Lee and Steve LeVay use often in their Trade the Morning mentoring room. They use the H pattern on usually shorter term time frames, but the H pattern is a pattern that can play out just like the Red Dog reversal, just like any technical pattern on longer time frames as well. And you see this H pattern forming here. It's a lowercase h, so you see the long stem and then the hump on the H, and it looks like it did break below these pivot lows today, but it looks like it could get some more downside if it gets a close below today's low or this pivot low here. So something to keep an eye on for a potential short. The company hasn't been doing real well. It had all that bad publicity from the CEO's comments and then a bad earnings report. And then just a one-off name, it's not a tech name, but often gets lumped in the momentum category because of all the momentum that it's had, is Chipotle. It's one that early in the morning looked like it wanted to break out as one of the stronger stocks. People were looking at it on the VTF. I know some of our contributors were watching it closely, but closed off its highs a little bit, not the type of power that you'd like to see on a breakout type move. It wasn't a breakout to new highs type move, but not exactly the most promising action. It just sort of sums up the market overall today and the market overall this year is that you've got some really nice short-term momentum action in individual stocks. Most of those stocks very speculative names that are not the type of names that I would look to buy at the beginning of 2014 and leave in the drawer till I retire or even for months or years, but names that can give you some short-term type price action. But when you're talking about besides the banks and I guess the biotechs, tech has really been very choppy, very individual action, nothing that really convinces you either way in the market right now. There's nothing telling you right now that, oh, this is a great dip buying opportunity or an opportunity to buy before another big bull run in 2014, but there's nothing really screaming that, oh, that big 10% correction in the market's finally coming. It's sort of wait and see mode right now, which at the beginning of a year, a lot of people would tell you that's not a very promising sign. You get maybe new inflows into funds and money being put to work that usually, at least over the last 5 years, has pushed the market higher in the first 5 days and sharply higher. But this year, you haven't really got very convincing action. So overall, I think you continue to take a short-term approach, look for some relative strength, relative weakness, maybe balance your basket a little bit with a few shorts and a few longs, maybe take a little bit more balanced approach, and overall just identify relative strength. I think this year in general is going to be more of a stock picker, market timer type environment. You're not going to get another 30% move in the S&P. So that's why off the charts, virtual trading floor, price point sheet, in these videos even maybe provide you some value, give you some ideas, and help you spot some relative strength and some trends and patterns. But anyways, welcome to 2014. It's going to be an interesting year for sure. If you have any questions about Scott's 2014 outlook and you ordered it, definitely shoot us an email or a tweet or a Facebook message or anything like that. We'd be happy to answer it. And good luck this year. Good luck the rest of the week. And this has been John Darsie, your editor-in-chief here for the Daily Recap. We'll see you later.
I'm Mark Sperling, Director of Trading with T3 Trading Group and contributor to T3 Live. Do you trade on your own, but you wish you enjoyed the benefits of a large trading floor? With the T3 Live virtual trading floor, we deliver that experience to you on your computer. On the VTF, you can follow the long and short positions of experienced professional traders like myself, Scott Redler, and others, and listen to our live radio stations as we navigate the markets. In addition, you get the added value of a large community of sophisticated and like-minded traders. In my opinion, joining the room will be the best trading decision you will ever make. I would like to invite you to begin your membership with a 7-day free trial. To get started, visit t3live.com and click on the Virtual Trading Floor tab. Have a great day, and I look forward to seeing you in the VTF.